Good afternoon and welcome to Unlock the Stock. We're pleased to welcome back for the third time the PBT Group to Unlock the Stock. As everyone knows by now, this Unlock the Stock platform is specifically designed for retail investors to gain access to corporate management and to get to know them and their companies just a little bit better. Listener Reed, the CEO, Bianca Peters, the CFO, and Francois de Wet, investment strategist and responsible for investor relations, join us today and will take you through a presentation shortly. Unlock the Stock is only possible with our technology partners, Lumi Global. Please visit their website at lumiglobal.com to learn more about their various online AGM and investor presentation solutions. Our hosts today, as usual, will be the Finance Ghost and Mark Tobin of Coffee Microcaps, and they'll be facilitating the Q&A session at the end of the presentation. Before we start, there are just a few housekeeping notes. Listener Bianca and Francois will take you through a presentation, which will be followed by a Q&A session. You can post your questions by typing them into the Q&A box at the bottom of your screen. The event is being recorded and will be available on the Unlock the Stock YouTube channel next week. You will also see an email address when we start the Q&A session, and if you would like to be added to PBT's distribution list, please send an email to that address. Bianca, I understand you're going to be sharing. I am ready for you to share your presentation and to hand over to the presenters.
Thank you very much.
Thank you.
Good afternoon, everyone. Elizna Reed, I'm the CEO of PBT Group. Over to my colleagues. Bianca is here with me, our CFO, and then obviously Francois de Wet, our investment strategist. Sorry, guys, just doing your introductions there for you, and then we can skip into the next slide and start our presentation. So, for those of you who've been following the journey, you would know PBT Group, but just for those who perhaps don't, PBT Group is a well-established consulting business focusing on data and analytics, as well as software engineering services. Our clients mostly consist of large South African companies, of which most are listed entities. And we have a, albeit small, presence in the UK and Europe. We were established in 1998 as Prescient Business Technologies, a specialist information management company. In 2006, we rebranded to PBT Group. In 2009, PBT IT, previously known as Gochseer, was included under the brand name. We've been listed on the Johannesburg Stock Exchange since 2010. PBT acquired 51% of CyberPro Consulting in 2012, which shareholding has since increased to 58%. In 2017, PBT Group disposed of Prescient Investment Management, continuing its JSE listing as a fully IT-focused business. We started our UK and Europe journey in 2018 when PBT Group EU was established, followed by the establishment of PBT Group UK in 2020. And here we are today, continuing the journey and focusing on our core business. The largest part of our business focuses on data and analytics as well as software development, with a small specialized business unit providing software as a service with a focus on medical healthcare insurance. Under the data and analytics offering, our main services include strategic and advisory services, analytics and visualization, data engineering, and artificial intelligence. Under the software development offering, our main services focus on software development, digital, cloud and DevOps, and automation testing. And then within insurance technologies, we provide proprietary software and the implementation thereof to clients in the medical aid industry specifically. Our highly experienced consultants are multi-skilled in terms of their service offering, both from a functional as well as technology perspective. We currently have over 800 employees in the group, with consultants fulfilling a range of roles spanning across the entire system development lifecycle. These include data analysts, business analysts, data architects, data modelers, data engineers, data visualization engineers, project managers, software engineers, software testers, DevOps engineers, and mobile and web developers. We continuously upskill graduates as well as existing consultants through our formal and informal internal training programs. One of these programs is the PBT Group Graduate Program, through which we provide young grads with further theoretical training focused on data and analytics. They furthermore receive hands-on practical experience under the mentorship of PBT specialists. This program has been running successfully since 2004. In 2023, we also introduced the PBT Cloud Academy Data Engineer Fast Track program, which is an intensive focus program providing high-performing STEM graduates with technical data engineering skills. So one of the group's main differentiators is the fact that we are product agnostic. We're able to advise and service clients despite chosen technology stack. Our consultants are multi-skilled and can easily switch between technology offerings. On display are some of the main current technologies we operate in, with those highlighted being vendors that we have formal partnerships with. 98% of our...
Oh, go ahead. No, go ahead. That's not... No.
Okay. I'll give you a turn just now, don't worry. 98% of our revenue is derived from low-risk time and material services. Our client engagements typically span over 12-month periods, more often than not recurring in nature, which gives us high visibility of our revenue forecast. Our clients typically remain for years, as is highlighted in the net revenue retention figure of 102% for our top 10 clients. And we still service some of the same clients we've had since the business was established in 1998. We have significant experience and coverage in the financial services and insurance industry, which clients consist of 72% of our revenue. But we also actively engage in other industries such as retail and telco, to name a few. We currently have more than 100 active clients across the group, including most of the large corporates in South Africa. Fransha, sorry if this was your slide. I'm sure we would have said the same thing. Okay. Okay. But the next one you can take, please.
Okay, I was obviously way too keen to start talking, but I think, what we're very fortunate in our business is that we operate in a growing industry, an industry that has a lot of tailwinds in both our two areas of specialization, our two big areas of specialization being the data and analytics services and the software development services. And both of these industries are expected to grow quite strongly in the coming years. So we feel that we are really well positioned in the areas in which we operate our business.
Yes, so our management employee shareholding of 54% confirms that our interests are well aligned with that of our shareholders. It's what we explain in this graph.
If we just look at the next two slides, it's just the financial highlights of the past financial year, the 2024 financial year, and then also a bit of where we zoom out and look at our performance over the past 5 years. But if we look at 2024, 2024 was a challenging year for us, but we still managed to grow our revenue on an organic basis by 3%. So this is the 5th year in a row that we've grown our top line. But the gross profit was somewhat unchanged at slightly down. But you can clearly see that there was some gross profit margin contraction there. And the reason for that gross profit margin contraction, there are two main reasons for that, is that we had some non-billability more in our data and analytics business, more than we had in the previous year. And then also we didn't put through all the increases of our cost of consulting through to our clients. The past financial year, one of the challenges that we had is that our clients they pulled back on some of their spend. So that was one of the main reasons for that non-billability that we had mainly in our data and analytics side of the business. But on the profit side, if our gross profit was flat, our costs still increased slightly. So we had the EBITDA coming down 5.6%. But so that was on the income statement side. But what we again this is about the 5th year now in a row, our cash generation is excellent. Our cash generated from operations 143.7 million versus EBITDA accounting earnings of 138.5 million. So our cash conversion again was excellent, and this is partly because of our excellent clients that we have. Our clients are, Ilana showed this in the previous slide. Our clients are JSE top 40 big businesses that are well capitalized, and so we've really got excellent clients. And then with the strong cash generation that we have, we again felt confident to up our payout ratio. Typically, we've paid about 75% of our normalized headline earnings per share as dividends, but we upped that payout ratio and we increased our dividend now for the 5th year in a row to 60 cents per share. And we will be paying that out on the 22nd of July to our shareholders. So all in all, the past financial year was challenging for us, but there are some big benefits that we continue to see in our business. Our cash generation is there, and we are able to pay and we increased our dividend again. Go to the next slide. Again, I think this slide is very important because we just have to take a step back and look at where we've come from. We've been a massive beneficiary of COVID, where our clients spent a lot of money on our services. You can see from 2020 up until 2023, we had incredible performance, and the last 2 years were flat to slightly down. But you still have to look at where we've come from, and our profits are still there. Our business is still highly cash generative. We continue to pay strong dividends, big dividends as a portion of our normalized headline earnings per share. So all in all, the last 2 years were a bit more challenging, but we've really performed well since 2019, and we are really happy with that performance of our business. To me, this is a feel-good slide, and also a slide just to highlight, that because we pay such big dividends, people oftentimes they forget that that must look at us on a total return basis. So they must add back the dividends to our share price to get a proper reflection on our share price. So to put this in context, what these dividends means, in the 1st of April 2019, our share price was R1.48, and since then we've returned R4.12 of dividends. So basically 3 times the R1.48 share price on the 1st of April 2019. So whenever people look at our business, because we've got this high payout ratio that we pay a large portion of our earnings out as dividends, people should look at us on a total return basis and look at what you're getting from our business, including all the dividends that we pay. Thanks very much. That was it from our side. We kept the presentation a bit shorter than previous years, and we're open to questions.
Thanks so much, Francois and Elisa, for taking us through that presentation. I'm just going to hand over directly to the Finance Ghost, Mark Tobin, to take you through the questions. Over to you guys.
Thank you so much. Thank you so much, Vanessa. Thank you to the team as well. Glad we got through the 1 or 2 little tech hiccups there. Never a dull moment with that. I think let's get the easy question out of the way up front, which will be relevant to a lot of people listening and maybe watching this on YouTube, which is that those who want to trade PBT shares on Easy Equities, you guys have got that 0 brokerage deal with them, which I think is still, I haven't seen it anywhere else. I think to my knowledge, it's still the first of its kind. Just worth spending a minute on actually, how that works and just why you've done it. I guess it's obviously to encourage retail investors into the stock.
Yeah, I think it's just a reminder. So anyone who wants to buy or sell PBT shares through the Easy Equities platform, we as PBT will reimburse your brokerage that you paid to Easy Equities. So again, the reason for that is just to promote more people to take part in buying and selling businesses on the JSE. So we're quite excited about it. This will be our 3rd year that we're doing it. So yeah, another year of free brokerage when you buy or sell PBT shares through the Easy Equities platform.
Francois, I don't know if you want to take this, or maybe Elzina, whichever one of you two, or maybe both of you want to comment. You talked about the last 2 years and the kind of a dip post-COVID with everybody spending and trying to get people working remotely. I mean, we're now a quarter into your new year. I mean, are you seeing that trend reversing or improving? You know, are you able to, you know, push on the full kind of price increases and costs that you're seeing, and just even a bit more activity, you know, people willing to kind of push the go button on, you know, new projects or things that have been in the pipeline that you know of for a while, but now actually, yes, we're going to get going. You know, what is the kind of mood? I'm thinking pre-election, post-election, you know, 1st of March was a new financial year, you know, it's new budgets, all of that. So maybe just where the current environment is as you see it from your clients.
Yeah, I'll take that, Mark. During the past financial year, we were not able to pass through the entire increase in the cost of consulting onto our clients. So our GP margin came under pressure because of higher than usual non-billability in our data and analytics business, due to client budgets constraints and projects being delayed. But almost 3/4 of our revenue is from clients in the financial services sector, where they've followed a wait and see approach to committing to new projects over the past 18 to 24 months. With the elections having passed and load shedding seemingly better, we are starting to feel more confident that our clients will ease up a bit, and it would of course be of benefit to us. So we are hopeful that that there's a turning point close by.
Maybe I can jump in with the next question, which I guess is kind of linked to that, which is around the skill shortage in South Africa that has historically been a concern. And obviously, when you're pushing cost increases through to clients, that's coming from the fact that you need to keep paying more and more to staff to be able to service those clients. So it really does talk directly to margins. And I know PBT, you've done a lot historically around bringing talent into the group, etc. So what are some of those trends around the skill shortage in South Africa that impacts you? And to what extent, maybe a sensitive topic, but one that faces all of us at the moment, you know, to what extent does something like AI and automation in some of the service offerings maybe pick up some of that slack where you can't necessarily get your hands on people or people at the right sort of price, where you can invest in other ways of servicing clients and getting stuff across the line?
Yeah, so probably two-folded question and answer there. In terms of the skill shortage, we do continue to see a brain drain to countries, obvious countries, such as the Netherlands, UK, Australia, and obviously much more. And yes, it negatively impacts the availability of skills. Corporates have also been on a drive to appoint permanently. So we already have a skill shortage within the country that becomes more specific to a service provider such as ourselves. When our clients start to appoint their own staff. And yeah, this is a cycle that we have seen in the past. And we, from what we see in the market, and we've reported on in our integrated report as well, we do believe that we have seen a turn there as well already. But the positive aspect of this is also that the demand for the skills that we specialize in remains strong. So that is a good thing in our again for the market that we operate in. We do continue to invest in graduates, as I previously mentioned, as well as existing staff through internal training programs to continue addressing the skill shortage. In terms of AI, we don't see AI replacing consultants or what we do, how we do it, but rather enhancing our skills offering, and perhaps helping us to quicker and in sometimes maybe a more streamlined fashion provide the services that we do. So we do derive value off it, although yeah, that's not necessarily going to address our the skill shortage as such.
Can we just maybe touch on, I know you said, you know, non-recovery of bills in the data and analytics team, but maybe just more broadly, what is the split between, you know, billable and non-billable, and, you know, how do you guys kind of keep that in check and try and, you know, recover as kind of much as possible? Because I know, you know, you like as soon as you get one little bit of slippage, it can, you know, really escalate on a project, and then you get project creep and all of those other things. I mean, maybe touch on that split between the two as a company as a whole, you know, within the full 800 odd staff.
Yeah. So yeah, the majority of our headcount consists of billable consultants, and mainly split into the two main areas of specialization, being data and analytics and software development. On the software development side of the business, we have 100% contracting staff. So we have zero non-billability, and that's obviously the larger portion of the business, which is great in, you know, when times are tough. It's back-to-back contracts typically, and, you know, with view of you delivering a specific service, and if there's another opportunity, we will engage, but if not, we move on, and that does not affect the business. On the data and analytics side, there's a split of, let's say, about 50-50, or maybe 60% permanent and 40% contracting staff. And that's where we do see non-billability from time to time, especially in times where the economy is taking some strain. It did bite us a bit in the previous financial year, slightly in the past financial year as well, because yeah, it's almost a double-edged sword. You constantly have to, if a project comes to an end, or a client ends a contract that you did not anticipate for their own budgetary constraint reasons, or whatever the case may be, you have to make a plan, find a new assignment, reassign the consultant, and whereas ideally you would have wanted to find another consultant to fill the new position, and have both of those guys billable. So yeah, it is a bit of a tough times, but the split, I think, just between the perm staff versus the contracting is something that has definitely been a huge advantage during the current times.
Something I'd love to touch on is just the competitive landscape, and I guess how that's maybe evolved, you know, in the past few years. I think back to a few years ago, PBT will always have a special place in my heart, because writing an article about the business was really what launched my life as the finance ghost. I still attribute a lot of it to that exact article. And that was really because you guys were kind of bursting onto the scene. Typical story of a small cap that was suddenly really coming into its own and getting attention in the market, which was lovely to see. And obviously attention and success tends to attract competitors. I mean, that's just simply the way the world works. So the question is around, you know, over the past few years, how has your competitive landscape evolved? Have you seen more competitors coming into the market chasing what is obviously quite a lucrative space? And of course, you know, this is a good opportunity to maybe talk to the moat you guys have in terms of the relationships with clients and how you keep those competitors out and maintain your market position.
Yeah, apart from well-known local competitors, we've for a long time been faced with Indian service providers, specifically on local soil. I do believe in a number of instances we've regained our footing against these competitors. But post-COVID, I think the biggest change in that landscape has been quite a surge in small startups. Plenty of those around. So yeah, it's an ever-evolving landscape. Yeah, I hope that answers your question.
And I guess maybe it's, sorry, Mark, I just wanted to maybe just push on that moat point slightly, which is, you know, to what extent do you have the long-standing relationships and, you know, that you're embedded in? I'll give you a global example. You know, I'm a Shell and Accenture. And the reason I'm a Shell and Accenture is because to such a large extent, they've become part of their clients. It's almost quite hard to get rid of them. You know, they've put in place things that mean they have to be there year on year. I've seen it myself in big corporates. And I guess part of the PBT benefit needs to be that, you know, it's a similar situation with your clients where you've become so entrenched in what they're doing that, you know, you'll still be there next year and the year after. Would that be accurate as an understanding of the value you bring to those clients?
Yeah, absolutely. It is I mentioned earlier, we've still got some of the same clients that we have when the business was established in 1998. And some have come and gone and come back again over time and grown beyond what it was initially. So, you know, even there where work had stopped at some point in time, the good relationships has carried us to the extent that, you know, when there is work to be done, they are happy to return to PBT and ask us to assist them. So yeah, client relationships, very important, and we do believe that we are entrenched in a good number of very decent clients. It helps us in all aspects of our financials, and yeah, that's definitely what's carried us. Even with the small competitors coming in, yeah, that does limit opportunities in some instances for growth. But it's not something that's putting us out of business or letting us lose clients as such at this point in time, I would say.
Can we just talk about maybe the client landscape, because you guys, you know, financial services is a key sector that you guys operate in. And I mean, if we look at, you know, what's happening in financial services, you've got like Time Bank, Bank Zero, Bidvest going to try and find a buyer for their banking operation, you know, Capitec moving into business banking. Is Discovery launching their own bank? You know, is that, I guess, explosion of digital banks, you know, a real positive for you in terms of, you know, established players trying to match them, or, you know, really put a focus on digital spend in order to kind of keep up with some of the bells and whistles that you can get from a Time or a Bank Zero, or to try and kind of keep them at bay? Maybe just talk about, because it is such a vibrant space. I mean, new banks in South Africa, if we take over the last even 5 years.
Yeah, again, if you look at our top, 72% of clients are in the banking and financial services industry, and it's been a good story. It's been, I won't mention specific clients, but it's been part of our success story to date. And we are fortunate enough to be quite heavily involved in at least one of the very new startup banks in South Africa at the moment. And yeah, it's definitely something that is giving us a boost and enhancing the latest technology being applied, and it benefits us across the group, both on the data analytics side as well as the software development side. So it's definitely to our advantage, and we are closely following along.
You know, Mark, I also want to add there that one of our slides in our presentation will also say that although we list a client as one client, we actually do business in a lot of different divisions within that client. So, for example, you just talked about now with the banks and the digital banks coming up with some of the already incumbent or financial services group that are launching banks, for example. What we also see is, like, if you look at a lot of the banks, they're going to different products, life insurance, telecommunications. We also start moving into those divisions within the banks, which is also something that works really well for us. So once we start with a client, then we also start moving into the different divisions of that client.
And the old bank assurance model seems to be re-energized.
I think let's move on to just revenue visibility. I think you've talked to how a lot of clients kind of sat on their hands in the run up to the election. And obviously we've seen that come through in a whole bunch of corporates, ranging from, you know, the cement industry has told us that things were quiet pre-election, through to, you know, corporate borrowings in banks. And then that obviously filters through into your client base, which then filters through into you. So that all makes a huge amount of sense. I'm just curious how much revenue visibility you actually have. You know, obviously this is a relatively project-based business with your clients. You've got an idea of what their needs are going to be and how you're going to service them. And revenue visibility is a wonderful thing, of course, because it helps you plan and leads to capital allocation decisions and everything else. So I'd like to just throw that on the table and just find out how much revenue visibility you have. Is it a year in advance? Is it 6 months? You know, to what extent can you accurately forecast what's coming?
I think your question is so well asked that there's not much that remained to be said. But that, yes, we do have quite good revenue visibility. I just want to go back one step, and I understand the way you're asking it, but just to clarify, while we participate in client projects, 98% of our services are, in fact, time and material based. But yes, as you say, it's client projects, and they know in advance what they're going to do, and we know what extent we will be involved. Our typical client contract is 12 months. So with that in mind, we have very good visibility, obviously, bar unforeseen changes in the landscape.
Can we just touch on the international operations for a second? Because I know you've decided to exit the Australia market now in the last financial year. And if we look at, I don't think it was in this presentation, but in one of the other presentations, I think the results presentation talks to the split between revenue internationally and locally, and it's, you know, remained kind of pretty flat around that 5% level. I mean, what is the plans for, you know, the Netherlands business? Does it still make sense to have an operation there, or is it make more sense, you know, to close that down and export the services directly from South Africa without having, you know, a holding company, staff, you know, everything there, rather just service the clients directly from South Africa?
I'll take that one. Our SA business makes up about 95% of our group revenue and has obviously grown faster than our international business over the past 5 years. Although we are very happy with our growth in SA, we would have liked to be bigger in the EU-UK region. We are not at this point at a stage to exit the EU-UK business. We do see more potential in UK than in the EU at the moment. So we're definitely not trying to exit at the moment. We will continue to see what we can do over there.
I've received a question. Oh, sorry, Mark, do you have a follow-on?
No, I just wanted to do one quick follow-on from that, and maybe one for Francois. I think you know, you've kind of stated, you know, acquisitions are not really at the forefront of your thinking in terms of growth, but I'm sure you wouldn't turn down you know, a good deal if it came across your desk. But just then, in terms of that leaves just organic growth, I mean, what are you aiming for trying to achieve in organic growth? Because I mean, PBT is still a small cap on the small end of small cap. You know, what is going to really drive the top and bottom line from an organic standpoint? You know, what is some of the plans you have there to really get it going, considering, you know, acquisitions aren't really going to be part of the mix from your perspective?
Yeah, I think this is a question for both myself and the listener, but just taking a step back, you know, we've really prioritized growing organically and also distributing a large amount of our earnings to shareholders in cash. And we haven't really prioritized acquisitions. And if you look at how we've grown since 2019 to let's call it 2023, in that 4-year period, we grew incredibly nicely on an organic basis without any acquisitions. Okay, so what we have, you know, thought of is that we haven't really needed to prioritize acquisitions to grow, because we've grown so nicely organically. So I think what could happen in the future is that you could look at perhaps doing a small, very bite-sized bolt-on acquisition in PBT from internal cash resources. So I'm talking very small, and that would be just to sort of enhance the current operations that we currently have, being in the data analytics space or the software development space, to just enhance those operations to get a bit of additional growth going forward. So that's sort of more on how we're thinking about it. And then in terms of the growth, I think that's perhaps, you know, more for a listener on how we're going to grow that out on an organic basis. But that's, yeah, I can talk. A listener, maybe you want to chat about that.
No, Francois, I think you've mentioned it.
Yeah.
I think you've answered it well. Thanks.
Yeah, I think growing in our clients, you know, organically in our clients, that's still a big thing for us. You know, we are still fairly small within our clients in their total spend on data analytics and software development. So there is still a lot of growth for us within client accounts. which is a lot easier to do than just always obtaining new clients. So I think growing within client accounts is a big thing for us. We've got a very long track record of doing that successfully. So yeah, we will continue doing that. And I think once the spend from the clients, from our clients starts coming back, when they at least have the confidence to spend again, because that's what we think. We think it's more of a confidence thing. Now that the listener touched on it as well, the elections have passed, load shedding is better. The financial services, our financial services clients they make a lot of money. They're doing really well at the moment. They were a big beneficiary of the higher interest rate environment. So we think it's a confidence thing, and we think that once they start spending again, I think that growth within those clients, we hope that will sort of increase again.
Francois, you actually partially answered a question that I got in my DMs around, what growth opportunities are you looking for in terms of existing clients versus new clients? And I think the point there is there's quite a long runway in your existing clients, and obviously always looking for new opportunities as well. And then I got an interesting question which talks to maybe some of the threats you face. I mean, obviously the opportunities are clear post-election, confidence among corporates, increasing spend, etc. The question is around the threat of AI. Now, obviously, we've talked already a little bit about how AI at best might, support your staff rather than replace them, which is great. Of course, there's the other side of AI, which is your customers and your clients. And to what extent might there be platforms that, impact some of your service offerings, if it's dashboards and data visualizations and that kind of stuff? Are you concerned that there might be technologies that come in and potentially make some of those services difficult, or do you believe you guys are at the forefront enough from a tech perspective that you can actually use those services rather than potentially face, replacement by them? Because obviously AI is a huge focus at the moment, and it's changing a lot of industries at a rate that is mildly frightening.
I think it's the latter. I do really believe that AI enables the core of our speciality being data services. So we believe as more organizations apply AI, the demand for our service will actually increase. We're focusing on two main streams of AI, being generative AI, examples being ChatGPT and Copilot, mainly to assist our data engineers to be more productive. And second, we're defining data techniques to assist data scientists to best prepare their data for producing the AI algorithms that the business requires. They actually end up using our data expertise, in other words, to enable AI. So as with the transition to cloud, many organizations are still finding their way to AI strategy and implementation and how to derive value. But we believe that all of this is underpinned by data. So we see it more as an opportunity than a threat at this point in time.
Francois, maybe another one for you. Got one in my DMs here. What has been the track record in acquisitions? Previously, they mentioned CyberPro here, but maybe we can talk about PayApps as well. Maybe just talk to how some of the previous acquisitions that happened through PBT's history have kind of been integrated, and the success or not of some of those historically.
Yeah. So I think the first one that's very obvious, and the one that in my mind would probably be the best acquisition we've done, it would be CyberPro, our 51% shareholding that we bought 51% of CyberPro back in 2012. We've subsequently increased that shareholding to 58% in the 2022 financial year. That business, I get quite excited about it, but that business we bought, I think, for 7 million rand back in 2012, and that business is now generating EBITDA more than 100 million for the entire business at the moment. So that was a very successful acquisition that we did. There were a few others that Ilesna will also be able to talk about. TBUS, Technique Business Technologies, BI Blue, InfoSight. There were a few of those acquisitions, and those ones we bought 100% of, and those we fully integrated into our business. And they were all very successful. So from a track record point of view, in terms of acquisitions, we've got 100% strike rate in terms of all the acquisitions that we've done. We haven't prioritized acquisitions over the past few years. The last few years we've only grown organically. And then obviously our big, very successful investment that we made was in PayApps in Australia. So that was a construction tech business. So how that worked is we had initially bought, this was in 2013, we had initially bought, it was $1 million Australian dollars that we put in 2013. In a subsequent funding round, I think it was in 2015, we had received our full 1 million Australian dollars back, and then we had sold it for it was essentially 155 million rand. I think it was 12 million Australian dollars last year, in the beginning of last year. So we've had a few really successful investments over the past. So yeah, that was really successful ones that we've done. That was the track record. So let me know if you have any other questions around that.
Okay.
Yeah, I can see Francois gets excited on the on the acquisition questions, Mark. Have you got another one on that, or can I ask something else?
Just no more broader one is, I think it's a good follow on, is maybe just talking about capital allocation, because I think it is worth spending a little bit of time on this. I know you've mentioned it in a couple of the answers and a few of in the presentation about, paying out a large chunk of profits in the form of dividends. And obviously there was the big special dividend from PayApps, which kind of has skewed the historical context to some extent. But you guys have also been doing capital reductions as part of, returning, dividends plus capital back to shareholders. So maybe just if there is a dividend policy, if it's 80% of cash profits, or 80% of HEPS, and that the thinking behind doing part of it as a capital reduction and part of it as just a straight dividend. Maybe if we can just touch on those capital allocation decisions.
Yeah, so let's exclude the PayApps dividend, because what we did with PayApps was we sold it and we returned all that money to shareholders. So if we just look at our capital allocation, let's call it our framework, we prioritize the organic growth and paying large dividends. And then we also look at share repurchases when the price is right in our mind. We did a big share repurchase back in 2020, March 2020. We bought 5 million shares back, so 5% of our share capital at R2.15 at that time. That was quite a good decision at that point. And then lastly, our lowest priority were acquisitions over the past 5 years or so. So I think if you look at our dividend policy on our ordinary dividends that we've typically paid out about 75% of our normalized headline earnings per share, and we retain the rest of that in the business that we used for share repurchases, or just retain that amount of cash. I think it's also important to note that if you look at the quality of our earnings, I want to say 100% of it is cash earnings. So for us, we are able to pay a really high dividend, a big portion of our earnings as dividends. And what we will continue doing is continue with that capital allocation framework, where we want to pay out a big portion of our dividends going forward. So yeah, I think there's not. I think what is a big thing for us is that we are able to pay these big dividends. It's not all the companies that I've seen that have such incredible cash generation, able to generate such good quality cash earnings like us.
And just the capital reduction versus the straight dividend.
Oh yes. Yeah. So on the capital reduction part, so what we did was we have a big contributed tax capital in our PBT Group Ltd as a big base, so we can pay that as return to shareholders as capital, or we can pay dividends. And what we found is that if you look at our shareholder base, 50-50 of our shareholder base, it's more advantageous to get it as a capital reduction, and the other 50% is better to get it as a dividend. So what we said is, let's split it in half. We'll pay 50% as dividends, 50% as capital reduction just because on our shareholder register, we benefit, that's the best way to benefit everybody. And that's the reason for it.
Okay. Thanks, Francois. I'm going to stop hogging the questions here now and throw back to the
That's
ghost.
fine.
Yeah, I was gonna say, Mark, you've got the weekend to get excited about this Ireland versus South Africa thing. I'm gonna have to claw it back a bit here, but anyway, moving on from rugby. So let's just talk EBITDA margin trends here. So obviously that's been a huge focus in the latest numbers, and I guess just high level understanding, what levers you can pull to actually just get that margin up. I mean, obviously you can, pay people less and charge clients more. That opens up a margin. I guess also stuff like higher value services. I mean, I noted some commentary around managed services and less dependency on hourly billing. So kind of just a broad strokes question to say, what levers can you pull and what are you pulling to try and get that EBITDA margin trend firstly backward where we like to see it, and then just continuing into the future?
Francois, you want to take it? You want me to take it?
Yeah, I can take that. Yeah, so I mean, on the EBITDA margin side, we've got basically one big lever to pull, and that's the one that we want to pull the highest, is to grow the gross profit at a quicker rate than our OPEX, and that will then also give us a nice EBITDA margin expansion. The other part is that we have is the mix in our business. So for our insurance technologies part of the business, it's about 10% of the attributable profit. It's fairly small, but it's a very high margin business. So as that business continues to grow, that should help us as well with our margin at a group level. And then, of course, just generally being very cost conscious on our OPEX line going forward. And we do feel that we have, we don't feel we have a big infrastructure that we have invested in creating. So, there is a big portion of additional gross profit that could come through in the coming years that won't have the same that won't lead to the same increase in costs. So for us, we've talked about this before, about the operating leverage in our business. But unfortunately, when the gross profit comes down, then that, or stays flat, then that doesn't really help. But we've got this cost base that we don't really see will increase much going forward, because we can service a much higher gross profit to what we currently have in our cost base.
Back to you, Mark.
You're going back to me. Okay, I didn't know if you wanted to jump in with two there.
No. All yours.
Yeah. And I know you've said, you want to grow share of wallet with existing customers, whether that's in, these big financial services crowd. If we take, First Strand, it's got the banking, it's got the insurance, it's got R&B. So even there, it's got, 3 different divisions. But I do just want to touch on, getting new clients. I mean, have you seen, that starting to come through in the business? Is there a business development team that, goes out and actively tries to source new clients? Or is it, guys, we've got some very, very big clients. As you said, Francois, we're a small part of their overall budget. There's much more we could be doing for them. I just want to get a sense of, is new clients even a focus for you, or is it just really trying to get a bigger share of wallet with these customers who know you, understand the value that you bring, and that, the relationships have been built, tried, trusted? Maybe just a touch on that.
I think it's definitely a combination of both. We've in previous sessions also said that, and I think Francois touched on it earlier, that within our existing clients, we provide services across different business units. So there's always that potential for growth and adding new clients within one corporate or one business. But I mean, yes, obviously we never shy away from new business. And when times are tough, you make an extra effort to go find that new business. So there's been actually an interesting mix of new clients that have been added in the past, actually in the year to date. Some definitely in the previous year, but in year to date, in the new financial year, we've added some new logos, which we're quite excited about. Some just small and you know, one or two consultants being placed. But you know, if we have a few of those and we get one where they realize the value and there's opportunity there, then obviously, yeah, that's the type of thing that can also aid us and answer the previous question where, you know, how do we get that GP growth again? So there's good potential and we're still excited for the future.
I'm good. Glad to hear there's, yeah, you're getting your foot in the door with some new clients. I mean, that's probably the hardest part, as you say. You know, you start off with 1-2 consultants, and you know, if it's a big enough business, then it can easily scale from there.
Exactly.
Absolutely.
I think maybe last question from my side, unless something else pops into my DMs, but just servicing international clients in general. I mean, South Africa has got a pretty good opportunity, or rather, well, reputation and opportunity for the skills we have. And from a time zone perspective, South Africa is very helpful. So I think we are becoming more and more of a business process outsourcing type destination. And that's been quite a strong trend, especially in the Cape Town office property markets, etc. So it's nice to sort of pick up those things and link across from the different companies we look at. But to what extent is that an opportunity for you guys, I guess, to have these South African-based teams as a margin expansion tool, you know, not just servicing South African clients, but to be able to service US clients or whatever the case may be? I mean, obviously, we've talked a bit about the international versus domestic strategy, but I think just specifically that BPO trend, to what extent can you participate in that, or are those services not really part of it?
Yeah, that's still the focus with our current international business, and I think as Bianca mentioned earlier, perhaps a stronger focus on the UK specifically and the other countries, but where we're at the moment in the UK, they are very very open to not just South Africans providing services, but also to outsourcing it. They don't necessarily have that requirement where you have to be we have to sit on site. That we see quite a bit in Europe, which I believe has hampered our growth there. UK is a different story, and that's definitely where some of the renewed focus and energy is going into at the moment.
I'm good on questions on my side. I'm just double checking my DMs, but I think I've covered off all of mine. So guys, thank you very much for joining us. Hopefully we'll see you on the Unlock the Stock platform again. And I see Vanessa has rejoined us here now as well. So I'll hand back to Vanessa to wrap up for us and let you know
Thank you very much.
the next
Thanks for
event is
having
coming
me.
up, because we've a pretty stacked calendar in July.
We do.
Thank you very much.
Thanks, Mark. And thank you to everyone who joined us today, but especially thank you to Francois, Bianca, and Elisna for the time that you've given up and the great discussion that we've had. I think it's always interesting to hear what you guys are doing, and the discussion has been fantastic. So thank you. We hope
Thank
that
you very
everyone
much.
on the call has enjoyed this event. And if you want to listen to it again, just a reminder that it'll be on our YouTube channel next week. Our next Unlock the Stock session, which will be taking place on the 11th of July, will feature 2 returning companies, which are Attack and Capital Appreciation. And just as a last reminder, as Mark said, July is jam-packed. We have something every Thursday in July. So please, can you pop across to the Unlock the Stock website and just have a look at those invitations. We'll also be sending that out to you. And that is a wrap from my side. Again, thank you very much to PBT for joining us, and goodbye from my side.